Listed infrastructure has been the center of notable market developments over the course of 2025. We have a brief update video outlining some of the major events that have impacted the asset class over the course of this year. We also present our outlook looking ahead for the asset class. If you have any questions, please reach out to me or please reach out to your CBRE IM representative more broadly. So when we think about a lot of the changes in markets over the course of 25, a few things come to mind. Number one is generative AI and power demand. Number two is the passage of major U.S. legislation, inclusive of the One Big Beautiful Bill. And number three is emerging themes as we think about over the balance of this year. So turning to generative AI and power demand, it's been effectively a 180-degree change between the news of the release of the DeepSeek development model compared to second quarter earnings updates from some of the major hyperscalers. And so where we are at today is effectively a situation where major hyperscalers have been increasing or affirming their levels of capital expenditures, and the need for power is absolutely been affirmed. So when you look across the major hyperscalers, collective capital expenditures over the next several years has a potential to reach close to $500 billion worth of an annualized run rate. And from power markets themselves, the signals there have been extremely positive. Major power market auction in the northeastern United States for power capacity fetched levels 20% above 2024 levels and over 10 times 2023 levels. We've also had several interim capital budget upgrades from our companies. One company within listed infrastructure, they increased their 5-year forward capital budget expectation by roughly 30%. And management noted that it was simply one of the strongest environments for both investment and for power demand that they'd seen over the course of their careers. So generative AI power demand absolutely affirmed post some notable changes and gyrations over the course of the first 2 quarters of 2025. Point number two, turning to the passage of the One Big Beautiful Bill. What we've seen here is we're now in a period of increased certainty for infrastructure relative to higher uncertainty going into this event. So where we are at today is that major renewable developers now have a guideline for when they get construction in ground, in place, what they can expect to achieve from wind, from solar tax credits. Nuclear tax credits remain unabated. All in, when you think about the passage of the One Big Beautiful Bill, it's probably the passage of the second best clean energy legislation in history following the Inflation Reduction Act. And so what we've seen post the decrease in that uncertainty, post the increase in that certainty, is some actions from the private market to express interest in listed renewable developers or listed integrated utilities that have been excessively discounted over the last several years. And we've seen that in an example in our own portfolios in the last several months. Point number three, uncertainty and infrastructure. Some emerging things to think about in the balance of 25 and into 26. So as news on tariffs waxes and wanes, as it changes, we would remind investors that listed infrastructure tends to be tariff agnostic. As costs rise, so do the costs to consumers that pay for infrastructure assets. And so actually very important of our underwriting is figuring out which companies have bill headroom, which companies can afford to increase their investments, and as a result, their own earnings. Infrastructure is very good in an environment of sustained high inflation or above average inflation. So should that come to pass, we have the potential to benefit. Infrastructure also very strongly benefits during periods of moderating economic growth, where resilient and contracted cash flows tend to be prized. And lastly, I would wrap up by saying that the potential for rate reductions, particularly in the United States, has the potential to benefit some areas of listed infrastructure that have underperformed over the course of the central bank hiking cycle. Wrapping everything up, 2 key building blocks for potential total returns as we look ahead. We expect a period of double-digit annualized returns for listed infrastructure over the next 5 years. The starting point for investors, that of relative valuations compared to broad equities, is exceedingly favorable. Infrastructure has tended to be and trade at a high single-digit premium on average over time, compared to a double-digit discount as of the end of the second quarter. Those same earnings, those same cash flows, they are accelerating approximately 150 basis points above historic averages. And we expect an increased duration to those earnings expectations, given a lot of the secular investment drivers that we have discussed. So when you think about the starting point for investors, the above average earnings growth, and that coupled with a very solid dividend yield from the asset class, we are optimistic on the potential for total returns when looking ahead. So that wraps up our update here for listed infrastructure. If you have any questions on the asset class or on listed real assets more broadly, please reach out to me. Please reach out to your CBRE IM representative. And I wish you good luck with your endeavors over the balance of this year and looking ahead into 2026. Thank you very much.